Did school ever teach you how to handle money? Yeah, me neither. And if your parents didn't either, you're not alone. Most people want more money, but very few actually know how to manage it. That's why so many struggle financially, even if they earn a decent income. So let's talk about it, not in a complicated, boring way, but in a way that actually makes sense. Think of money like a game. Some people know the rules, make smart moves, and build real financial security. Others just wing it, spend without thinking, and wonder why they're always broke. Financial literacy is basically understanding how to play the game properly, how to earn, save, invest, and spend in a way that benefits you, not just keeps you afloat. And here's the thing, making more money isn't always the answer. There are plenty of people making six figures who are still drowning in debt, while others with modest incomes are steadily growing their savings and setting themselves up for financial freedom. It's not just about how much you make, it's about what you do with it. At its core, money is just a tool for exchanging value. You work, you provide something useful, your time, skills, or products, and you get paid. But here's the catch. Most people trade their time for money, then spend it as fast as they earn it. That's why so many feel stuck in an endless cycle of working, paying bills, and repeating. The real goal is to get your money working for you, instead of the other way around. That means learning to save, invest, and build income streams that don't require you to clock in every day just to stay afloat. Why does all this matter? Because life is expensive. You want to travel, buy a house, retire comfortably. None of that happens by accident. If you don't learn how to manage your money, it'll end up managing you. Imagine your car breaks down, your phone dies, or you suddenly need to move. If you don't have savings, those small problems become major financial headaches. But if you've planned ahead, they're just minor inconveniences. Financial literacy isn't about being rich overnight. It's about making money less stressful and putting yourself in control. It's knowing where your cash is going, making smarter decisions, and setting yourself up for the kind of life you actually want. So if you're tired of feeling like money is slipping through your fingers, let's break it down in a way that actually makes sense. And more importantly, helps you make better moves starting today. Making money isn't just about having a job. It's about understanding how income works and setting yourself up for long-term financial success. Most people grow up believing that a steady paycheck is the only way to make a living. You go to school, get a job, work hard, and hopefully retire comfortably. But what if that job isn't enough? What if an unexpected expense drains your savings? What if layoffs happen and you're left scrambling for a new paycheck? Relying on a single source of income is like walking a tightrope without a safety net. That's why smart financial planning involves building multiple income streams. Let's start with the basics, earned income. This is what you make from a job, whether it's an hourly wage, a salary, commissions, tips, or bonuses. Your paycheck is the foundation of your financial life, so it's important to choose a job that pays well enough to support the lifestyle you want. But it's not just about the numbers on your paycheck. Benefits matter too. Does the job offer health insurance, retirement contributions, or paid time off? Is there room for promotions and salary increases? And most importantly, do you actually enjoy the work? You might earn a high salary, but if you hate waking up every morning, is it really worth it? Now let's talk about profit income. This is money earned by selling a product or service for more than it costs to produce. Business owners and side hustlers rely on this type of income. Whether it's selling handmade products, running an online store, or starting a freelance business, profit income has no real earning limit. The challenge is that it requires effort, risk, and patience. Not every business succeeds, but the potential for high rewards makes it worth considering. Another way to make money is through interest income. This is when you earn money simply by letting a bank or financial institution use your savings. If you keep your money in a high-interest savings account, bonds, or fixed deposits, the bank pays you a small percentage in return. It's a slow but steady way to grow your money without any effort. You won't get rich overnight, but it's completely passive. Your money works for you while you sleep. Then there's dividend income, which comes from owning stocks in companies that share their profits with investors. Unlike the stock market's ups and downs, dividends provide a steady stream of cash flow. Many wealthy people use this strategy to build passive income. buying shares in reliable dividend-paying companies and collecting payouts every few months. The best part? You don't have to sell your stocks to make money. Rental income is another popular way to build wealth. This could mean buying a property and renting it out, but it's not limited to real estate. People make rental income from cars, storage spaces, tools, or even high-end camera equipment. The idea is simple. Own something valuable. Let someone else use it and get paid for it. The challenge is that managing rentals can take time and effort, but once set up, it can generate reliable income. Then there's capital gains, which is money made from buying something at a low price and selling it at a higher price. This could be stocks, real estate, or even collectibles like rare sneakers or art. The key here is patience. Investors hold on to assets for years, allowing them to grow in value before selling for a profit. It's one of the biggest ways people build long-term wealth, but it does require market knowledge and a bit of strategy. Finally, we have royalty income. This is when you create something, like a book, song, software, or even a patent, and get paid every time someone uses it. Think about musicians who earn royalties every time their song is played, or authors who keep making money from books they wrote years ago. It takes effort up front, but once your work is out there, it can bring in money for years without any extra work. So what's the takeaway here? The more ways you earn money, the more financially secure you'll be. Relying on just a paycheck is risky because life is unpredictable. Imagine losing your job and still having other income streams to fall back on. That's real financial freedom. Even if you're just starting out, you don't have to make drastic changes overnight. Small steps, like investing in stocks, starting a side hustle, or renting out something you own, can add up over time. The goal isn't to work harder forever. It's to build income streams that keep money coming in, even when you're not actively working. When you reach that point, you're no longer just working for money. Your money is working for you. Relying on just one source of income, like your paycheck, can be risky. If that paycheck suddenly stops, your expenses don't go away. That's why it's smart to have money coming in from different places. Think of it like a table. If it only has one leg, it's unstable. But if it has multiple legs, like income from investments, a side business, or rental properties, it stands strong no matter what happens. There are two main ways to make money: active income and passive income. Active income is when you trade time for money, like working a job, freelancing, or running a business that requires your daily involvement. Passive income, on the other hand, is when money keeps coming in with little to no effort after the initial setup, like renting out a property, earning dividends from stocks, or getting royalties from creative work. The goal is to have enough passive income so that even if you stop working, money still flows in. One of the easiest ways to build passive income is through investing, putting your money into something that grows over time. This could be a business, real estate, or stocks. You don't need to be rich to start investing, but investing is how people become rich. A great starting point is the stock market. Stocks make money in two ways: capital gains, where you buy shares at a lower price and sell them later at a higher price, and dividends, where companies share a portion of their profits with investors as cash payments. If you're new to stocks, you have two main ways to get started. The first is managing your own investments by opening a brokerage account and choosing your own stocks, ETFs, or mutual funds. Before jumping in, think about what kind of investor you want to be. Are you looking for long-term growth? Then growth stocks might be your thing. Want regular cash flow? Dividend stocks could be a good option. Prefer a hands-off approach? ETFs, which spread your money across multiple stocks, are a solid choice. Next, decide where you want to invest: U.S. stocks, international markets, or a mix of both. Then, choose an investment account that fits your situation. Some accounts have tax benefits, while others give you more flexibility. The second option is letting a robo-advisor handle everything for you. If picking stocks and monitoring the market sounds overwhelming, a robo-advisor can do the work. You just answer a few questions about your risk tolerance and goals, and it automatically builds a portfolio for you. All you have to do is deposit money, and the system takes care of investing, rebalancing, and reinvesting dividends. It's a stress-free way to grow your money over time. Real estate is another powerful way to create wealth, but instead of just buying a house to live in, you can use property to generate income. There are a few ways to do this. You can buy a home or apartment, rent it out, and collect monthly payments. Another approach is flipping houses, buying a property, renovating it, and selling it for a profit. Or you can hold on to a property as its value increases over time and sell it later for a higher price. Of course, real estate isn't as simple as just buying a house and making money. You'll need to research markets, secure financing, and possibly work with property managers, contractors, and realtors. If buying a property isn't financially feasible right now, you can still invest in real estate through REITs, real estate investment trusts. These are companies that own and manage properties, and you can buy shares in them just like stocks. REITs allow you to earn rental income and benefit from property appreciation without actually owning any real estate. Owning a business is another way to generate income. You don't have to build a startup from scratch. You could start a side hustle by selling digital products, offering a service, or running an online store. Another option is buying an existing business that's already making money. If you don't want to run a business yourself, you can invest in one and earn a share of the profits. Unlike a regular job, a business has the potential to scale, meaning you could eventually make more money without working more hours. But like anything, it comes with risks, so it's important to do your homework before diving in. Having multiple income streams isn't about working nonstop. It's about setting yourself up so that money flows in from different places. Even small steps like investing a little each month or renting out an extra room can add up over time. The goal is to create a financial setup where you're not just earning to survive, you're building wealth that supports the life you actually want. Before jumping into starting a business, take a moment to really think it through. What kind of business do you want to run? Do you want to sell physical products, offer a service, or maybe do something digital like an online course or subscription model? Will you be targeting customers in your local area, or do you want to reach people worldwide? And most importantly, can this business actually make money? A lot of people get excited about starting a business without considering whether it's financially sustainable. A great idea is only half the battle. You also need a solid plan for how you'll market your business, handle expenses, and eventually turn a profit. Most businesses don't get approved for loans in their first couple of years, so you'll probably need to fund it yourself, whether that's through savings, side income, or finding investors. Before your business even gets off the ground, there's some paperwork to handle. You'll need to register your business name, decide if you'll operate as a sole proprietor or incorporate, and look into whether you need a business license. If you're selling products, you might need to register for sales tax, depending on where you live. And don't forget about business insurance. It's not the most exciting expense, but it can protect you from a lot of financial headaches down the line. If you're hiring employees, that's another layer of responsibility, including payroll, contracts, and tax obligations. It might sound overwhelming, but setting everything up properly from the start will save you a ton of stress later. Think of it like building a strong foundation before constructing a house. You don't want things to collapse just because you skipped a few steps. Making money is great, but if you're spending every dollar as soon as it comes in, you're not really getting ahead. A business can bring in a lot of revenue, but if you're not managing that money wisely, it won't matter in the long run. This applies to personal finances too. Earning more won't automatically make you financially secure if your spending habits don't change. At its core, saving is simple. Spend less than you earn. The difference between what you make and what you spend is your savings. But while it sounds easy, actually doing it is where most people struggle. If you don't know where your money's going, it's nearly impossible to save effectively. That's where budgeting comes in. A budget isn't about restricting yourself. It's just a plan for where your money should go. The main categories of a budget usually include necessities like rent, groceries, and utilities, wants like dining out and entertainment, debt payments such as credit cards or loans, and savings for future goals like an emergency fund or retirement. There are tons of different budgeting methods, so you have to find what works for you. Some people prefer tracking every expense manually, while others use apps that categorize spending automatically. Once you start tracking your expenses, you'll quickly see where your money's going. That's when you can make adjustments. Maybe you're spending way more on takeout than you realized, or you have subscriptions you don't even use. Cutting back on unnecessary spending doesn't mean you have to live like a monk. It just means being intentional with your money so you can actually build financial security. At the end of the day, both business and personal finance come down to smart money management. Whether you're running a company or just trying to improve your financial situation, the key is making informed decisions, tracking where your money goes, and consistently setting aside savings. Once you get that down, you'll have a solid foundation to grow. Whether that's expanding your business, investing, or just having the freedom to do what you love without stressing about money. A simple but powerful way to save money is to pay yourself first. Think of it like this. When you get paid, before spending a single dollar on bills, food, or entertainment, you set aside money for yourself, your future self to be exact. It's the financial equivalent of serving yourself food before dishing it out to everyone else. If you wait until after you've paid for everything else to save, chances are there won't be much left. But if you make saving your first priority, you'll always have something put away. And if you happen to have extra money left at the end of the month, great, save even more. To make this process effortless, set up an automatic transfer from your checking account to your savings account every time you get paid. That way you don't even have to think about it. It just happens in the background. It's like setting up a subscription for your future financial security, except instead of paying for yet another streaming service, you're building a safety net. Now, where should you actually keep your savings? The goal is to earn the best interest rate possible. The reason is simple: inflation. Over time, things get more expensive. That means the money you save today won't have the same buying power in the future. For example, if inflation is 2% a year, that $100 in your savings account will only be worth about $98 in terms of what it can buy next year. This is why finding a high-interest savings account is important. It helps your money keep up with rising costs, so you're not losing value just by letting it sit there. That brings up another question. Should you save or invest? It depends on what the money is for. Savings accounts are great for emergency funds and short-term goals. Things like having cash available for unexpected expenses or planning a vacation in the next year or two. But if your goal is long-term, like retirement or your child's college fund, investing is the better move because it gives your money the chance to grow over time. Let's say you're saving for a house. If you plan to buy it within the next couple of years, it's best to keep that money in a safe place, like a savings account, rather than investing it. The stock market can be unpredictable, and the last thing you want is for your down payment to drop in value right before you need it. But if your goal is 5 or more years away, investing might make sense. Even if the market dips, say because of a recession or some unexpected global event, you'll have time for it to recover before you actually need the money. At the end of the day, the key is to put yourself in a position where your money is working for you, not just sitting around losing value. Paying yourself first, choosing the right saving strategy, and knowing when to invest are simple but game-changing habits that can make a huge difference in your financial future. When it comes to handling your money, one of the first things you should do is set up an emergency fund. Think of it as a financial safety net, something to catch you when life throws unexpected expenses your way. A good starting point is saving at least $1,000 to $2,000. That's enough to cover common emergencies, like car repairs or medical bills, without having to rely on credit cards or loans. Once you've got that initial cushion, aim for something bigger, enough to cover 3 to 6 months of your essential living expenses. This amount isn't the same for everyone. It depends on your situation. If you have a stable job in a high-demand field, you might not need as much as someone whose income is unpredictable. If you have health issues or support a large family, your emergency fund should be bigger because you have more responsibilities. That said, don't go overboard with saving. Holding too much cash in a regular savings account won't help you grow your money, especially when inflation eats away at its value over time. The goal is to strike a balance, save what you need for emergencies, then focus on investing to actually grow your wealth. Now let's talk about spending, something most people do naturally but not always wisely. You can't just hoard money and only invest. You also need to cover everyday necessities like rent, groceries, and transportation. The question is, how do you manage your spending in a way that keeps you in control? The tool you use, whether it's cash, a debit card, or a credit card, can make a big difference. Cash is the simplest way to limit spending because once it's gone, it's gone. It's great for avoiding debt and can sometimes get you discounts when paying in person, but it's not always practical. Losing cash means it's gone for good, and you can't use it for online shopping or automatic bill payments. A debit card is a step up. It's like carrying cash but with more convenience. You can use it for online payments, send money easily, and withdraw cash from ATMs. Plus, if you lose it, you can cancel it, unlike cash. The downside? Some banks charge fees, and using a debit card won't help you build credit. If you're looking for no-fee banking, some online banks like Tangerine, Simply I, and Modus Bank offer free checking accounts, which can help you save on unnecessary charges. The key takeaway? Whether you're saving, spending, or investing, make sure your money is working for you, not the other way around. A credit card is basically a short-term loan that lets you buy now and pay later. If you use it the right way, it can help you build credit, earn rewards, and even protect your purchases. But if you're not careful, it can also become a financial trap with high-interest debt that's hard to escape. Before you get a credit card, it's important to understand the basics. Every card comes with an interest rate, which is what you'll pay if you don't pay off your balance in full each month. There's also a grace period, a window of time where you can pay off what you owe without being charged interest. Some cards come with extra fees like cash advance charges when you withdraw money from an ATM using your credit card, or foreign exchange fees when you make purchases in a different currency. So why use a credit card? First, many offer purchase protection and extended warranties, meaning if something you buy gets lost, stolen, or damaged, you might be able to get your money back. Premium cards even come with perks like airport lounge access and roadside assistance. Plus, some cards give you cash back or reward points for your spending. But here's the catch. Credit cards typically have high interest rates, usually around 20% or more. If you don't pay off your balance in full each month, the interest charges can pile up fast. That's why the best way to use a credit card is to make small purchases and pay off the full amount before interest kicks in. This helps you build a strong credit history without getting into debt. If you're just using a credit card for rewards, make sure you're not spending more than you can afford to pay back. If credit cards tempt you to overspend, a safer alternative is a reloadable prepaid MasterCard or Visa. These work just like a debit card. You load money onto the card and can only spend what's available. Some options like Koho, Stack, Mogo, and PC Money Account even offer cashback and budgeting tools. The downside? They don't help you build credit, but that can actually be a good thing if you're trying to avoid debt. That said, having a good credit score is important. It helps you qualify for better credit cards, lower interest rates on loans, and even things like renting an apartment. So while a prepaid card can be useful for budgeting, at some point, it's worth learning how to manage a credit card responsibly to improve your financial options in the long run. Let's talk about debt, because not all debt is bad. Some kinds can actually help you get ahead, while others just drain your wallet. Think of it like this. Bad debt is money you borrow for things that lose value or don't make you any money, like maxing out a credit card on shopping sprees, taking out a car loan for a luxury vehicle you can't afford, or using payday loans to cover everyday expenses. These types of debt usually come with high interest rates, making it harder to get out of the hole. Good debt, on the other hand, is debt that works for you. It's the kind of borrowing that can help you build a better future, like a student loan that leads to a higher paying job, a business loan that helps you grow a profitable company, or a mortgage that allows you to own a home instead of renting. This strategy is called leverage, using borrowed money to increase your earning potential or net worth. When done wisely, it can be a game changer. Now, besides managing debt, you also need to think about protecting what you have. That's where insurance comes in. You don't want to build up your finances just to lose everything in an emergency. If you drive, you need car insurance. If you own a home, you need home insurance. If you have people who depend on you financially, life insurance is a must. And if you run a business, business insurance helps cover unexpected risks. Beyond insurance, you should also make sure your money is protected. If you're in Canada, your cash account should be covered by the CDIC, Canada Deposit Insurance Corporation, and your investment account should be protected under CIPF, Canadian Investor Protection Fund. This means that even if something happens to your bank or brokerage, your money is safe. So how do you actually get good at managing money? The good news is you don't need a finance degree. There are tons of free resources, YouTube videos, blogs, podcasts, financial calculators, and even free workshops that can teach you the basics. If you want to go deeper, books, courses, and mentorships can help. But here's the truth. The best way to learn is by doing. You can watch 100 videos about investing, but until you actually invest, you won't fully understand it. And trust me, everyone makes mistakes in the beginning. But if you wait until you have more money to start, your mistakes will just be more expensive. Start small, learn as you go, and improve over time. At the end of the day, financial literacy is about giving yourself options. The more money you waste, the more time you waste. But the more you understand money, the more freedom you have. Whether that's to travel, retire early, or just live life on your own terms. I know this was a lot, but hopefully it gave you a clear idea of what's important when it comes to money. If you want to keep learning, stick around, check out my other videos, and start making smarter moves with your money. See you in the next one.